check out this bank thing. I think we got to do that because I think that's the most important thing. Nobody's talking about it probably because they don't understand it, but Bloomberg laid it out pretty nicely. So let me give you a quick rundown on what's going on with that. So you guys know Citadel from the GME thing. Nobody really knew too much about it before that, but most profitable hedge fund in all of history, made $83 billion since it was created in 1990. And they're doing so well. They're building what's going to be the second tallest skyscraper in New York. That's going to be done in like 7 years. So things are going good for Citadel. Ken Griffin. I mean, you know Ken Griffin. He's worth $33 billion. He's so good at trading. He like back when he was in college, he was actually like managing money for his professors and doing pretty well with it. I mean, I wish that I was my age in the 70s. That was a nice time to crush it in the stock market. But anyway, so shadow banks are too big now to stay in the shadows. So look at this. So what we got? Shadow banks do a lot of work that commercial banks do without being hampered by strict government regulations. So that means hedge fund, it's like the role that like government contractors play. They do stuff that's like too crazy for the government to do. Shadow banks do stuff that's too crazy for banks to do. And they're operating at like a 12-to-1 debt to cash ratio on average, right? But the real crazy thing about this, though, is that they're using money from money market accounts. You know, like the place that you were told is safe to put money to get a quick 5% return every year. A lot of retirement accounts are attached to that. And they pull money out of that and just gamble with it. So if anything goes wrong, the money market funds are going to be bled out and they're going to tell you that your retirement's not there anymore. So the Fed's already putting together this bailout plan, which I think would be like the clearest sign possible that nothing is changing if Trump goes ahead and allows a bailout again. Because, you know, mark my words, something's going to happen. Like it's like what we've built for ourselves. It's like when what California did with the forest fires, where they just let a ton of that flammable brush stuff build up over years and years and years. When you're supposed to have controlled burns, they don't do it. They put it off. They neglect it for whatever reason, and then eventually just the smallest spark, like some hobo in the woods smoking a cigarette, lights the entire state on fire. That's what our financial system is essentially. Like we have never allowed them to have feel serious pain in the last probably 50 years. Like, 1987 bailout, low rates. 2001 dropped the rates to 1%. 2008 dropped the rates to 0%. QE for the last 15 years. During COVID, pumped $3 trillion into the economy year one, and then $6 trillion overall over the course of 4 years. So never let our economy feel any serious pain. And, we just have a whole forest filled with flammable brush, to make an analogy that everybody can understand. And they're probably going to do the same thing here because it's such a disaster that everything will break if they actually allow us to feel some pain. But how does this conclude? What do we become Japan, where Japan literally is at 0% rates for the past 30 years because their market can't handle even the 0.1% rate? And then look what happens with that. You destroy your currency. So back to the article. So if downturns or brutal stresses arrive, the traders of these types of institutions aren't necessarily backstopped by central banks like the Federal Reserve. So as traditional lending banks can be. So central banks have had to step in and shore up wobbly banks in markets numerous times over the last century, including during the 2008 crisis, 2020, and the Silicon Valley thing. I forgot about that. So that one too. Funny thing, everybody says, and people were asking me the other day, if I'm FDIC insured, does that mean that the bank will give me, up to $250,000 no matter what, even if the bank goes under, or the bank has a bank run on it? Yeah, in theory, but funny thing, I think I looked up the other day, I think there's $11 trillion worth of deposits, but only $200 billion in the FDIC's account. So they don't have anywhere close to the amount of money they would have to potentially cover if there's a series of bank runs and bank failures. But we'd probably just print money if we had to. And that just destroys the value of our money. So it's a net loss. I mean, it's so crazy to me that I heard some kid in my office say today, we got to get those stimmies again. The fact that people still don't realize that the stimulus checks were a net loss for everybody that doesn't have a ton of money invested in the stock market is crazy to me. Like you have a one-time payment of $1,500, but then permanent 20% inflation for the next 10 years if like you really add it up properly, not the way the government does. So Bloomberg goes on to say, as markets tank again in response to Trump's Liberation Day tariffs, there are real risks of a crisis of faith in the U.S. as a reliable world power. And crucially, it hurts in treasury bonds, which underpin shadow banking. Yeah, so treasury bonds, I try to kind of drill this into everybody's head as much as I can. It's like the backbone of the entire world economy. Like they call U.S. treasuries like the tier one collateral, like the safest form of collateral you could have. You know, like when you borrow money, you put something up so that people feel safe about it. You know, like if you ask your friend to borrow $10,000, you let him borrow a $10,000 watch, then like, that's a reasonable form of collateral. And for whatever reason, I say that rhetorically, it's not for whatever reason. Like there's clearly an incentive that the government puts in place for people to find those desirable. But the financial world considers U.S. Treasury bonds the safest, most reliable form of collateral out there. So when they lose their value, it creates big problems because like the same freaking bond gets borrowed and lent out like 7 different times. So, you know, you could use a bond as collateral, then the institution that you give it to as collateral can give it to another one as collateral. And then that could happen like 7 to 10 times, really no cap on it. So there's just like this series of bonds being used as collateral. Their value goes down even a little bit. Big problems, margin calls, and then the whole thing falls apart. So that's why some experts are arguing for permanent shadow bank safety nets. There you go. If taxpayer funds need to be pledged to do that, then regulators will have to consider tighter supervision of shadow banks as well, even though some Republicans in Congress are calling for a rollback in potential federal oversight. So the players in the shadow banking world, Citadel, $65 billion hedge fund, and it doesn't have JP Morgan's $4 trillion fortress balance sheet, but it probably has as much, if not more, power to shape markets. The size and influence of major alternative asset managers has only grown since 2020, and the hedge fund industry has become more concentrated among the largest players like Citadel, DE Shaw, and Millennium. Hedge funds collectively now use more borrowed money to fuel their trades than at any time since the Fed began to collect data in 2013. So that's just an absolute recipe for disaster. So look at this chart. U.S. hedge funds borrowing hit record levels last year. So I don't think I need to explain the prime brokerage and repo market. That's kind of too in the weeds. So but it's more than ever before. I'll just know that. So with these secretive alternative institutions at the heart of the next financial crisis, will they be? Citadel and other big hedge funds argue they don't need more regulation because they're safer than banks. They say that locking up investor money for longer terms means they don't rely on the kind of panicky depositors who start bank runs. What the hell? So I logged out for a second. Oh, that was weird. All right. So with these secretive alternatives, here we go. With these secretive alternative institutions be at the heart. Yep. So it's certainly possible these big funds are more stable than most people imagine. Citadel offers a useful example of why that might be. So even the most well-managed firms are still vulnerable to system-wide shocks. When a major crisis hits, markets that normally seem uncorrelated can suddenly move together with a terrifying speed and distance between safety net and doom vanishes. Or as statisticians like to say, anyone interested in determining what might be done to prevent shadow banking-induced meltdown should ponder some recent financial history. Yep. So when Lehman Brothers collapsed in 2008, many analysts and bankers hoped this would be an isolated failure, but federally backed lenders like Fannie Mae and Freddie Mac also got swept into the emerging vortex, as did major U.S. banks like Washington Mutual and Wachovia. Soon after, giants like Citigroup Inc. and Bank of America needed financial life support as well. I just dropped a video about all this, so check that out if you want to know more about it. There's like so much that we don't know about 2008, or so much that the average person doesn't know, and we really got shafted in the biggest possible way. So total losses in 2008 exceeded $2 trillion. U.S. home prices fell by 1/5. Unemployment doubled to more than 10%, and America suffered its deepest recession since World War II. Politicians and financial regulators then created a wide-ranging rules to prevent the same thing from happening again. But even after 2008, there was still a market for risk. Private equity firms still wanted to buy sluggish businesses and load them up with potentially risky debt to drive greater payoffs when selling them on. And speculative arbitrage, which is buying and selling related assets in different markets and profiting off the price gaps, was still needed to help price bonds and derivatives and keep markets liquid. Investment banks did this work before 2008. Today, hedge funds have picked up the liquidity supporting functions, but without the limits on borrowing or reporting requirements that even standalone investment banks like Lehman Brothers had to observe. So they're being more risky than Lehman Brothers and have less oversight. And we haven't really had a difficult situation that kind of sheds light on this. So there could be some real nasty stuff ahead with these guys. Market-based finance has boomed far more than regulators ever expected. Globally, what regulators call non-bank financial intermediaries, the shadow banks, as well as pension funds and insurance companies, have grown at an average annual rate of 1.5 times faster than traditional lenders. Total shadow banking assets have more than doubled globally to 240 trillion. Among these funds, specifically involving supply credit to the companies and people, grew to 70 trillion, according to Financial Stability Board and a watchdog group. In the UK, almost all debt taken by companies in Britain since 2008 has come from markets, not banks, according to the Bank of England. Process that. Banks are supposed to be the lenders. They're not doing any of the lending. It's coming from private markets. So that's some serious stuff. We don't know the ramifications of that. This is the first time this has ever been the scenario. And we haven't been allowed to have a serious market correction yet because we've just been, putting on easy mode. It's like if you're at a bowling rally and you have the bumpers up, that's how our economy's been since 2008. So we have no idea, to stay with the analogy, how good of bowlers these guys are who run the hedge funds, run the banks and everything. They've made it impossible for them to fail virtually unless they're doing something absolutely crazy. So investment banking, commercial banking were once sharply divided in the U.S. They're talking about Glass-Steagall here. So very important thing, Glass-Steagall, the Glass-Steagall Act. After the Great Depression, the government said, hey, you crazy bankers, we have to divide commercial banking and investment banking into two different things, which basically said that the bank can't take your bank deposits and go use them to speculate and gamble with, because, they lose a lot, and that's how banks fail. But the brilliant Bill Clinton and Larry Summers, unbelievable. This guy is trying to not take blame for all the stuff that's happened with China, but they cooked up the idea that it would be a good idea to repeal the Glass-Steagall Act. So they did that in 1999. And then a lot of people say that's what led to the housing crisis because, investment banks got bigger, between 1990 and the year 2000. The top 5 banks went from controlling 25% of banking assets to, I think, 40% of it. And then today they own 56% of it. And small banks just been obliterated, which if you saw Richard Warner on the PPD podcast the other day, he said the lifeblood of a country, of a good, healthy country with a healthy economy is small banks, because they have to be more frugal about the type of loans they give out. These big banks just get into giving out these crazy loans and these no income, no asset type of mortgages, all that crazy stuff. So that's a real problem. I'll show you a chart in a second, maybe of the small banks falling off a cliff. Ken Moelis, who founded his own small investment bank, Moelis & Co. in 2007, said he expected the 2008 crisis to force the financial world to revert to its divided pre-1999 state, meaning undo the repeal of Glass-Steagall. He thought that would happen slowly, however, as he told a conference in December, quote, "What surprised me is that it's not taken 30 years. Financing," he said, "is radically changing from a bank-centric market where it was for most of my career to an alternatives, life insurance, pension fund, sovereign wealth market. A plain vanilla banking and more high-flying shadow banking truly did inhabit different worlds that might offer some comfort to anyone worried about systematic risk. But this clean division is an illusion." So the mighty Citadel, the total assets of the hedge funds are more than 15 times greater today than in 2008. Mutual funds are still larger, but the big hedge funds are more influential because they trade more and can use borrowed money to amplify their firepower. Citadel is the most profitable hedge fund in history, at least by one measure. So I told you, 83 billion since 1990. These are the big five: Citadel, D.E. Shaw, Millennium, Bridgewater, Elliott. The fund's success argues against instability fears that haunt shadow banking. That's due in part to Citadel's long track record, but its approach to borrowing and risk management are also major strengths. Citadel is a multi-strategy fund with hundreds of managers trading almost every market imaginable. This protects it against losses in any single area and makes it more attractive as a client to bank and brokers. Voluminous trading and diversification are virtues, particularly in the eyes of big banks that have been lending heavily to hedge funds. Private asset managers and other non-bank rivals. Direct lending by banks to financial firms, including hedge funds and private asset managers, has been the fastest growing part of the U.S. banking system. It hit $1 trillion last year, according to a recent Bloomberg News analysis. Multi-strategy funds are the biggest borrowing beast among the hedge funds. Their average gross their gross debt is currently above $12 for each $1 in the fund. Highest ratio on record. According to the U.S. Treasury Department Office of Financial Research, that kind of leverage can amplify returns when invested successfully, but destroy capital faster when trades go wrong. The demise of long-term capital management, that's a big one. That's a big one. In 1998 is a vivid reminder of how swift and ugly such debacles can be. And a lot of people say long-term capital was a big money laundering drug, money laundering type of venture, allegedly. We definitely talk about that another day because there's some fascinating stuff there and really crazy. Like they let people think they got ripped off, but it was like a money laundering operation. I've been finding some crazy stuff the last couple of days, guys. I've been finding some crazy stuff, especially with that missing 36 trillion from the Pentagon. But stay tuned. So Citadel has built uncommon defense against those scenarios that make it less vulnerable to panicky lenders. Unlike peers, Citadel has issued 1.6 billion of investment-grade public bonds. That's a small part of its overall borrowing, but it does not need to be repaid for 5 years. No other hedge fund has gone as far as issuing investment-grade debt to lock in funding for longer terms that insulates them from short-term market disruptions. Citadel has long. Oh, here we go. Okay, this clip started playing. I know we're sorry. All right, where was So Citadel may be an isolated example. However, the top 10 hedge funds, the top 10 U.S. hedge funds more than doubled their repo borrowings since the start of 2023 to 1.43 trillion. So the repo market is this crazy thing that the Fed has set up where it's basically if the banks don't have enough money at the end of the day, they get to borrow money from other banks. So that's what the federal funds rate is. That's like the overnight borrowing rate for bank-to-bank lending. I mean, it's crazy. It's the only thing in the world where, like, businesses can't do that. They can't say like, oh, I don't have enough money today to pay the rent. Like, hey, buddy over there, could you lend me this for the day? And then I'll, issue new money to pay you back. So banks operate on a different playing field. And if you ever hear the word repo market, repo purchases, it's just like overnight bank-to-bank lending or Fed-to-bank lending, et cetera, et cetera. So that's at an all-time high. And quick thing, in 2019, right before COVID, the repo market exploded. I'll show you that in a second if you're interested. But that's usually a sign of bad things to come. And although mega funds might try to mimic Citadel's approach, the data on how prudently they're actually managing the terms of their funding isn't available. That leaves central bankers in the dark about their vulnerabilities. Where might those weaknesses reside? Big investment banks increasingly finance multi-strategy hedge funds on a portfolio basis, meaning they lend against trades cumulatively rather than individually. The idea is that the risks of some bets should balance out others, making banks feel more comfortable about lending. Diversification feels like insulation until it doesn't. The COVID-19 pandemic proved the point in 2020 when there weren't any safe havens. Portfolio lending can also transmit losses from one market to another. If a hedge fund's trades in corporate bonds go wrong, for example, it might sell other assets such as treasuries to meet lenders' demand for cash, stressing government bond markets. Or the problem could start in government debt markets. Hedge funds trading also affects other asset managers along shadow banking chain, which is where the risks of sudden instability are least well understood. Consider treasury basis trades, a form of highly leveraged arbitrage that keeps the treasury market humming along. While extreme leverage itself is inherently risky, basis trades also play a role in supplying credit to companies and a phenomenon that has been under-examined. So they're talking about corporate debt right there, the corporate bond market. And apparently that's one of the scariest things for everybody in this economic ecosystem is when the corporate bond market kind of shits the bed. Like that was the first thing to really go. And apparently the vast majority of funding and revenue for companies is from the corporate bond market. Like a lot of companies can't operate their day-to-day payments and functions without the corporate bond market. So if this thing like sells off and rates go high, or if it gets really expensive, like it throws the whole thing out of whack. So I think that was the first thing the Fed started pouring money into during COVID, because they just totally freaked out when the corporate bond market went off. Let's see if I can pull up a chart with that quick. Corporate bond markets. All these things that sound boring, but very important to the things you care about, because this thing shits the bed, then your 401k could shit the bed. Chart. Here we go. Do they have good charts for this? Yeah, they do, I think. Yeah, we'll come back to that. Anyway, a basis trade typically involves buying treasury bonds and selling treasury futures, but mutual funds are some of the biggest buyers of treasury futures to support the corporate debt investments. If hedge funds had to rapidly unwind basis trades under duress, or regulators suddenly imposed tough limits on leveraged lending from markets to companies would likely shrink too, hurting the economy. Yeah, that's the number one fear, is the shriveling up of that access to debt market for American companies. Most importantly, hedge funds are at the mercy of the money market funds. There you go, your retirement account. The source of much of their borrowed cash, these instant access cash funds have doubled in size to nearly 11 trillion worldwide since 2008. According to the FSB, and are considered super safe because they're mainly meant to own stable government debt. But in the US, money market funds lent up to 1/3 of their cash into the shadow banking system by swapping it for treasuries for short periods of time, according to research from the Bank for International Settlements. The risk is overt because many traders are ultimately financed with short-term funding, the opposite of the strategy Citadel uses to try to reduce term risk. Okay. Money funds are the de facto depositors in the shadow banking system, and their investors can demand their cash back at any time. That's not good. Who bears the risk of this so-called maturity transformation in the now you see it, now you don't world of shadow banking? It's partly big hedge funds themselves and partly the repo brokers that source funding, and those brokers are often part of big banks. So that's part of what the problem with Silicon Valley Bank. What happened with them is that they had a lot of bonds in their balance sheet, and like the bonds lost a lot of value, but the bonds got called back before they expected to have to sell them. So they had to show that loss when they had to give the bonds back. You know, if they were able to wait and let the bonds go back to a normal level, then it wouldn't have been a problem. But they lost, like whatever, 30% of their value because rates started going up, and they had to sell them at a loss. So they suddenly had this giant loss in their balance sheet, and then people got wind of it, started withdrawing the money, and then the whole thing falls apart. So the money market fund and repo loans to shadow banks are booming. So look at this, and this is just in the past couple of years. Interesting that starts in 2018. That's worth looking into why it's doing that. So when did this thing really start? Really started in 2024. That gets like crazy. That's strange. So obviously the light blues banks, the dark blues non-banks, like these shadow banks. So connections across market and fund types and the hedge fund fulcrum on which they rest are all underappreciated. Big hedge funds are better managed in many ways today than long-term capital management was in the 1990s. But there are many more of them now. They're much bigger and more influential, and their borrowings on average are at record highs. A failure today would likely be far more damaging to the wider system. So what should regulators do? Bloomberg asks. Klaas Knot, president of the Nederlandsche Bank, is not popular in hedge fund land. He currently chairs the Financial Stability Board, a group of global central bank chiefs and regulators. He has launched task forces to investigate shadow bank leverage and how big hedge funds might spark or accelerate sell-offs. Watchdogs like Knot can end up focusing too tightly on specific firms and activities when they should be examining the entire shadow banking chain instead. Any regulator system that works will have to subject all large hedge funds to stricter guardrails and treat them more like banks. Some backstops are already being considered or are in place. A group of academics recently urged the Fed to set up a lending facility for major hedge funds that could be deployed if a crisis arose in treasuries. The Bank of England has opened a new lending window for pension funds and insurers to protect the UK government debt markets from a repeat of the near meltdown that occurred in 2022. Just to set the record clear, a lot of people believe that it was the IMF that attacked Europe's bond or England's bond market in 2022 because they didn't like who became the prime minister. What was her name? The woman who was there for like 2 months. She has like a one-syllable name. I'm gonna look it up. It's gonna drive me crazy. UK woman prime minister. 2 years ago. Oh, Liz Truss. There you go. Boom. Okay. Doesn't drive me crazy. So yeah, I think that was an attack by the people who didn't like her policies because it's really easy to push around the bond market of a smaller country, but story for another day. So expanding the central bank support to hedge funds would be very unwise when the Trump administration and the House Republicans want to reverse a Biden-era policy that gave regulators a route to greater oversight of shadow banks. Man. Reforms shouldn't mean setting strict limit on how many dollars hedge funds can borrow per dollar of capital, as has been floated by the FSB. That's too blunt. The industry has correctly pointed out a fund levered at 10 to 1 that invests mostly in government debt is far less likely to get wiped out than a fund that puts the same amount of borrowed money into stock markets. I mean, the bond market still fluctuates pretty crazily, and if you have to sell it before you intended to or before you want to, then you're in trouble if you have to take that loss. Because if you wait till maturity, then you get your full money back. But if you have to sell before maturity and it's lower, if the rates are higher than it was before, that means the price is lower, and then you lose money. So what's needed is a set of complementary guardrails, including a simple leverage ratio models of the worst losses likely over each month and year, a measure of spare cash at hand. These three gauges are akin to how regulators controlled banks since 2008. Risk-based capital leverage and liquidity. Seeing clearly how different mega funds manage their risk and borrowing terms would help the Fed decide whether any firm is too aggressive and could signal appropriate operating limits for all. Much more transparency is needed. Regulators should require shadow banks to report much more, at least confidentially, about their balance sheet management. Regulators and central banks can then think more clearly about the systematic risk of today's big, influential, interconnected funds. Let's see. I think we're good on this. All right. Yeah. So any questions about this? Because the main takeaway of this is that there's a problem. Everybody's saying it, just like at one point in time before. And the Fed is being encouraged to set up a bailout hedge funds. And I saw a channel saying the other day that it could be as much as $2 trillion the Fed gives out. Is this one we just looked at? See, Bloomberg was like, so this isn't an older article than the one we just looked at. The first line: the Federal Reserve should consider setting up an emergency program that would close out highly leveraged hedge fund trades in the event of a crisis in the $29 trillion U.S. Treasury market, according to a panel of financial experts. Get that shit out of here. What do you guys think about that? I know Alan loves that. I know yeah, I know you're all about that. Um let's talk about Tim Pool because this guy's falling apart